In the early 20th century, investors wired money into a bank that did not exist. There was no headquarters, no vault, no reserves, no charter. Yet deposits kept growing. Newspapers printed its name, officials referenced it, investors trusted it. On paper, it was solvent. In reality, it was fiction. This was not a bank robbery. It was a banking scam built entirely on perception, paperwork, and confidence. For years, money moved into an institution that had no physical foundation, only reputation and carefully engineered trust. When the illusion collapsed, millions vanished. This is the story of the bank that never existed and the system that allowed it to appear real.
In 1907, a new financial institution began appearing in regional newspapers across the United States. It introduced itself as a private banking house with international reach and conservative management principles. Its advertisements were modest in tone, but precise in language. Security was emphasized repeatedly. Stability was presented as its core mandate. The name of the bank was printed in serif typefaces commonly associated with established institutions. Letterheads carried engraved crests and formal seals. The typography resembled that of legitimate East Coast financial houses. Printed materials referenced correspondent relationships in London and New York. These relationships were never independently confirmed. A board of directors was listed in promotional brochures. Each name was accompanied by a short professional biography. The credentials appeared respectable. Verification, however, was difficult in an era before centralized corporate registries. The bank claimed to hold diversified reserves. It stated that deposits were backed by conservative asset allocations. Balance summaries were mailed to potential investors. The statements showed steady asset growth. Liabilities were categorized neatly across deposit classes. Reserve ratios appeared strong. No auditing firm was named. No regulatory charter number was printed. The absence of these details did not immediately attract scrutiny. In 1907, the United States banking system was fragmented. Oversight varied by state. Information traveled slowly. The Panic of 1907 had recently destabilized trust companies and regional banks. Public confidence was fragile. Depositors were searching for signals of safety. The new institution understood this environment. Its messaging was calibrated to address fear without appearing opportunistic. Circulars emphasized prudence rather than profit. Interest rates offered were competitive but not extraordinary. This moderation reinforced credibility. Mail correspondence was prompt and professionally formatted. Responses carried consistent signatures. Deposit certificates were embossed and sequentially numbered. The numbering implied scale. Early interest payments were issued exactly on schedule. Small depositors received confirmations without delay. Administrative precision replaced physical presence. No photographs of offices were ever published. No description of a vault location was provided. The listed headquarters was only a mailing address in a commercial district. There were no publicly accessible premises. Yet the documentation created tangibility. Paper substituted for infrastructure. Consistency substituted for transparency. Over time, repetition replaced verification. The institution existed first in print. It then existed in conversation. Eventually, it existed in the assumptions of its depositors. Capital followed those assumptions. Structural takeaway: legitimacy is often engineered before capital exists.
By the early 1900s, banking regulation in the United States was divided between state and federal authorities. National banks operated under federal charters issued after the National Banking Acts of 1863 and 1864. State-chartered institutions were governed by inconsistent regional standards. Private banking houses often fell into an even looser category. Many operated without formal federal oversight. Licensing requirements varied significantly across jurisdictions.
Some states required minimum capital thresholds. Others required little more than registration paperwork. Disclosure standards were limited. Mandatory external audits were rare. Financial reporting was not standardized. There was no centralized database of licensed institutions. Verification required physical inquiry. Most depositors did not conduct such inquiries. The phantom bank exploited this fragmentation. It avoided claiming a national charter. It avoided specifying a state license. Its language remained deliberately ambiguous. It described itself as a private banking house. Private status implied exclusivity rather than vulnerability. Regulators were primarily reactive. Investigations typically began after complaints surfaced. As long as deposits were honored, scrutiny remained minimal. Early interest payments prevented complaints. Satisfied depositors generated silence. Silence reduced regulatory attention. The bank did not open physical branches. This eliminated the need for building inspections. It operated through correspondence. Mail-based banking reduced geographic accountability. Deposits were wired or mailed. Documentation was returned with formal acknowledgement. The absence of a physical vault did not violate any explicit statute. No law required photographic proof of reserves. No law required real-time disclosure of asset holdings. Statements were accepted at face value. The regulatory environment assumed good faith. Fraud statutes existed, but enforcement required evidence. Evidence required investigation. Investigation required suspicion. Suspicion required visible irregularity. The institution engineered stability to avoid irregularity. Interest payments continued. Balance sheets showed orderly growth. There were no sudden collapses, no immediate defaults. Regulators saw no crisis. In fragmented systems, absence of crisis is often mistaken for compliance. The phantom bank operated within that blind spot. Structural takeaway: regulation always lags innovation.
The bank's credibility depended heavily on its financial statements. Each quarterly circular included a summarized balance sheet. Assets were listed in precise categories. Cash reserves appeared substantial. Government bonds were listed as primary holdings. Short-term commercial paper was described as diversified. Real estate loans were categorized as secured. The presentation followed conventional accounting structure. Total assets always exceeded total liabilities. Reserve ratios were shown as conservative. No independent auditor was identified. No verification stamp was present. The documents relied entirely on internal representation. Cash reserves were never independently confirmed. The listed correspondent accounts were not publicly validated. Some asset categories were intentionally vague. Descriptions such as secured commercial instruments provided flexibility. Flexibility allowed reinterpretation. Circular accounting mechanisms were quietly embedded. Interest payments to earlier depositors were recorded as operational expense. New deposits were categorized as capital inflow. Reported growth masked dependency on continuous funding. There was no disclosure of liquidity position. Maturity mismatches were not discussed. The balance sheet projected solvency. Solvency was inferred from orderly formatting. Tables were clean. Columns were aligned. Totals were consistent. Visual order implied financial order. Investors rarely questioned line items. The terminology sounded technical. Technical language discouraged deeper scrutiny. Most depositors lacked the expertise to interpret ratios. Confidence replaced analysis. Each new statement reinforced the previous one. Growth appeared linear. There were no sudden spikes, no dramatic fluctuations. Stability was simulated through incremental reporting. The illusion required discipline. Figures could not contradict prior publications. Numbers were adjusted carefully to preserve continuity. Minor increases sustained the narrative of steady expansion. Paper assets required no vault. They required only repetition. Accounting structure became the architecture of the institution. Depositors trusted arithmetic. Arithmetic became authority. Structural takeaway. Accounting can create the appearance of stability.
The institution did not rely solely on documentation. It relied on repetition. Its name began appearing regularly in regional newspapers. Small financial notices listed it alongside established banks. These listings created associative legitimacy. Editors rarely verified private banking advertisements. Advertising revenue incentivized placement. Paid space was mistaken for endorsement. Occasional opinion columns referenced the bank's steady growth. No investigative scrutiny accompanied these mentions. Repetition normalized existence. Readers encountered the name multiple times per month. Familiarity reduced doubt. Local business directories began printing its address. The address was a mailing office. Few readers questioned physical access. Public perception was shaped by printed frequency. The bank's name migrated from advertisements to commentary. Writers referenced it as part of the broader financial landscape. Its inclusion implied integration. Integration implied validation. Community leaders occasionally cited it in public remarks. Such references were indirect but powerful. Authority signals accelerated trust. Trust expanded depositor base. Social proof replaced independent verification. Depositors assumed others had performed due diligence. New clients referenced existing clients. Word of mouth amplified printed exposure. No dramatic promises were made. The tone remained conservative. Moderation reinforced authenticity. As deposits increased, the bank published summarized growth figures. Growth statistics were reprinted by newspapers without independent confirmation. Journalistic standards for financial verification were limited. Fact-checking infrastructure was minimal. Editors relied on supplied information. Supplied information shaped public record. Public record shaped perception. Perception shaped capital flow. The illusion strengthened with every citation. Absence of controversy was interpreted as credibility. Silence was interpreted as stability. Critics were few. Those who questioned the bank lacked platform amplification. Positive mentions dominated print space. Media repetition manufactured confidence. Confidence translated into deposits. Deposits reinforced the appearance of legitimacy. Structural takeaway. Media repetition manufactures confidence. The bank's continued growth cannot be explained by paperwork alone. It depended on human psychology. In the early 1900s, banking literacy among the public was limited. Most depositors evaluated institutions through social signals rather than balance sheet analysis. Trust was inferred from presentation. Authority bias played a central role. Formal language implied expertise. Engraved seals implied regulation. Structured documents implied oversight. Few investors understood reserve ratios. Fewer understood liquidity risk. What they understood was consistency. Interest payments arrived on schedule. Statements were delivered predictably. Predictability reduced suspicion. Depositors compared notes with acquaintances. Early participants reported satisfaction. Reported satisfaction encouraged imitation. Imitation created momentum. Momentum created fear of exclusion. As deposits increased, the perception of safety increased. Growth itself became evidence of legitimacy. People assumed that widespread participation implied verification. If others trusted the institution, individual caution weakened. No extraordinary interest rates were offered. The returns were competitive but restrained. This restraint reinforced authenticity. Excessive returns trigger doubt. Moderate returns reinforce credibility. The bank understood this dynamic. It did not promise rapid wealth. It promised disciplined stewardship. Discipline is easier to believe than ambition. Depositors also sought stability after the panic of 1907. Memories of suspended withdrawals remained fresh. The phantom bank positioned itself as insulated from such turmoil. Safety messaging aligned with public anxiety. Anxiety increases susceptibility to reassurance. Reassurance increases deposit inflow. Written testimonials were occasionally circulated. Testimonials provided narrative reinforcement. Narratives travel faster than audits. Most depositors lacked the means to physically inspect operations. Verification required effort. Trust required none. Over time, skepticism appeared unnecessary. Nothing visibly failed. Nothing visibly contradicted the narrative. Confidence became habitual. Habit replaced inquiry. The institution's greatest asset was not capital, it was belief. Structural takeaway: trust is more powerful than verification.
As deposits increased, the institution announced expansion. Circulars referenced new regional representation. Additional mailing addresses were published. These were forwarding offices, not operational branches. No physical banking halls were opened. No vaults were constructed. No tellers were hired. Expansion existed primarily in correspondence. Letters referenced growing geographic reach. Maps were occasionally included in promotional materials. The maps suggested national presence. Presence was implied, not demonstrated. Depositors in distant states believed the bank operated locally. Local presence reduces perceived risk. Risk perception influences deposit size. The bank understood this. It maintained consistent branding across all communications. Paper quality remained high. Seals remained embossed. Typography remained uniform. Uniformity suggested institutional scale. Operational infrastructure, however, remained minimal. There were no public annual meetings. No shareholder gatherings were recorded. No property acquisitions were documented. Growth was described abstractly. Assets were listed generically. Branch expansion announcements lacked physical addresses. Most depositors never attempted in-person visits. Correspondence-only banking reduced scrutiny. Mail created distance. Distance reduced verification. Verification requires proximity. The institution capitalized on geographic separation. Expansion announcements were timed with deposit milestones. Milestones were framed as evidence of success. Success reinforced safety. Safety attracted additional capital. Administrative efficiency masked operational absence. Response times were carefully maintained. Delays were avoided. Professional formatting maintained credibility. The institution scaled perception faster than it could have scaled infrastructure. In reality, there was no infrastructure to scale. All growth occurred in statements and correspondence. The larger it appeared, the less it was questioned. Scale substituted for substance. Substance was never demonstrated. The bank expanded reputationally, not physically. Structural takeaway: perception can scale faster than operations. As deposits accumulated, the critical question became liquidity. Where was the money actually held? Official statements claimed diversified reserves. In reality, the structure was far more fragile. Deposits were not stored in a central vault. They were routed into a small number of personal controlled accounts. These accounts were held under affiliated entities. Separation between institutional funds and personal access was minimal. No independent custodian oversaw balances. Early deposits funded operational expenses. Interest payments to initial investors were financed by later deposits. The mechanism resembled a primitive Ponzi structure. However, it was presented as ordinary banking flow. New deposits were categorized as capital inflow. Interest disbursements were recorded as routine expense. Cash circulation concealed structural insolvency. As long as inflows exceeded outflows, stability appeared intact. Reserve claims were never reconciled with actual liquidity. Liquidity depends on immediate accessibility. Accessibility was limited. Funds were often redeployed to cover prior commitments. No large-scale investment portfolio existed. No diversified bond holdings were independently verified. Paper reserves substituted for real reserves. The institution depended on deposit velocity. Velocity masked imbalance.
If withdrawals remained small, the system held. If withdrawals increased, strain would appear immediately. The bank counted on depositor passivity. Most clients reinvested interest rather than withdrawing principal. Compounded reinvestment slowed cash exit. Slow exit stabilized illusion. No external audit tested solvency. No regulator demanded proof of reserve composition. Confidence substituted for compliance. The bank's leadership understood timing. Interest payments were never delayed during growth phases. Delay would trigger suspicion. Suspicion would reduce inflow. Reduced inflow would expose insolvency. The structure was stable only under expansion. Expansion was mandatory, not optional. Each new deposit financed prior obligations. The cycle required uninterrupted trust. Cash flow created the appearance of solvency. Solvency did not actually exist. The illusion functioned as long as belief persisted. Structural takeaway: cash flow hides insolvency. By the third year of operation, subtle warning signs began to surface. A small number of depositors reported delayed correspondence. Interest payments occasionally arrived several days late. Explanations were administrative. Clerical backlog was cited as the cause. Few considered liquidity strain. Withdrawal requests increased slightly after regional market volatility. Most requests were processed. Some were encouraged to roll over deposits instead. Rollover incentives were framed as loyalty benefits. Longer-term commitments reduced immediate outflows. Reduced outflows preserved liquidity. Preserved liquidity sustained appearance. Rumors began circulating in limited circles. Questions were raised about physical location. No public branch had ever been visited. The mailing address was confirmed as a rented office suite. No vault was present on site. This information did not reach most depositors. Local inquiries lacked national amplification. Newspaper mentions continued without skepticism. Positive reinforcement outweighed emerging doubt. Internal pressure increased as deposits slowed. Slower inflow tightened margin between inflow and obligations. The system required steady growth. Growth began to plateau. Plateaus exposed structural weakness. Minor delays became slightly more frequent. Correspondence tone shifted toward reassurance. Reassurance often signals strain. Leadership emphasized stability in circulars. Overemphasis suggested fragility. A handful of investors requested full withdrawals. Large withdrawals required sourcing funds from new deposits. Sourcing became more complex. Payment sequencing became strategic. Smaller withdrawals were prioritized. Larger withdrawals were negotiated. Negotiation replaced automatic processing. Automatic processing is hallmark of liquidity. Liquidity was narrowing. Insiders recognized imbalance. Outsiders saw continuity. Continuity masked deterioration. There was no dramatic event yet, no headline collapse, only incremental stress. Incremental stress rarely triggers immediate panic. Warning signs accumulate quietly. Structural takeaway: collapse signals appear long before collapse. The liquidity strain eventually intersected with a confidence shock. A regional financial downturn triggered higher withdrawal activity. Several depositors requested full redemption of principal. These were larger accounts. Processing them required significant cash movement. The institution delayed response by several days. Delay created suspicion. Suspicion spread through correspondence networks. Letters between investors compared experiences. Patterns became visible. Interest payments were no longer uniformly punctual. Withdrawal confirmations slowed. Rumors escalated beyond local circles. For the first time, newspapers received critical inquiries. Editors began asking questions about physical headquarters. No verifiable location could be provided. The mailing address offered no evidence of vault operations. Journalists attempted site visits. They found only clerical reception. No cash reserves were visible. No operational infrastructure existed. Confidence shifted rapidly. Banking stability depends on belief in immediate liquidity. When belief weakens, withdrawal demand accelerates. Acceleration strains available cash. The institution attempted reassurance through urgent circulars. Statements emphasized solvency. Solvency without liquidity is irrelevant in a run. Depositors sought cash, not explanation. Requests multiplied. Each fulfilled withdrawal reduced remaining liquidity. Each denied withdrawal increased panic. The structure had no contingency reserves. There was no lender of last resort. In 1907, central bank mechanisms were limited. The Federal Reserve would not be created until 1913. Without external liquidity support, the institution faced direct pressure. Deposits stopped increasing. Outflows exceeded inflows. The balance turned negative. Payment sequencing collapsed. Correspondence became defensive. Defensive tone confirmed instability. Newspaper skepticism intensified. Public doubt became visible. Visible doubt triggered further withdrawals. The run was not dramatic at first. It was cumulative. Cumulative pressure exposed fiction. Structural takeaway. Banking stability depends on belief. Withdrawal pressure intensified. Journalists began formal investigation. Editors requested documentation beyond promotional circulars. They asked for charter records. No federal charter number could be produced. They requested state registration filings. No verifiable state license was located. Reporters attempted to identify listed directors. Several names could not be traced to existing financial professionals. Biographical details lacked independent confirmation. Questions were published publicly. Public questioning altered perception. Regulatory officials were forced to respond. Inquiries were initiated at state level. Correspondence between authorities revealed inconsistencies. The institution claimed correspondent relationships with major banks. Major banks denied formal partnership. Denial undermined credibility. Investigators visited the mailing address again. They confirmed it was a rented forwarding office. No vault existed. No reserve storage was present. Financial statements were requested under oath. Supporting documentation could not be produced. Reserve balances were not independently verified. Asset categories lacked identifiable securities. Circular accounting patterns became apparent. New deposits had financed prior obligations. The structure resembled misrepresentation rather than mismanagement. Legal classification shifted from private banking to fraud inquiry. Depositors began demanding collective action. Public confidence collapsed. New deposits ceased entirely. Without inflow, interest payments stopped. Without interest payments, the illusion ended. Media coverage intensified. Headlines reframed the institution as a fictitious. What had been accepted as a bank was now described as a phantom. Transparency accelerated collapse. Documents that once reassured now appeared fabricated. Reputation reversed direction rapidly. Trust evaporated faster than it had formed. Investigative exposure replaced repetition. Repetition had built confidence. Exposure dismantled it. The institution's existence was revealed as administrative construction. Paper had substituted for capital. Confidence had substituted for compliance. Once verified absence became visible, continuity was impossible. Structural takeaway: transparency ends illusion instantly. Once the institution was publicly exposed, legal proceedings followed. State prosecutors initiated fraud investigations. Charges centered on misrepresentation and unlawful banking activity. Depositors filed civil claims seeking restitution. Asset recovery proved limited. Most deposited funds had already circulated through internal accounts. No substantial reserve pool existed. Paper assets dissolved under scrutiny. Leadership figures were summoned for testimony. Financial records were incomplete. Several listed directors denied meaningful involvement. Some identities had been exaggerated. Others had been nominal associations. Criminal liability focused on primary organizers.
Court proceedings documented the absence of charter authority. The institution had never been legally recognized as a regulated bank. Depositors confronted the reality of unsecured claims. Unsecured claims yield minimal recovery in insolvency. Losses were distributed across hundreds of investors. Many were middle-class savers. Some had transferred life savings. The total financial damage reached into the millions in early 20th century dollars. Adjusted for inflation, the losses would represent far larger modern equivalents. Public reaction was severe. Editorials criticized regulatory complacency. Questions were raised about verification standards. Legislators debated tighter oversight of private banking houses. Trust in unregulated financial entities deteriorated. Reforms were discussed at state level. Stricter licensing requirements gained support. Disclosure expectations expanded. Public appetite for centralized oversight expanded. In 1913, the Federal Reserve Act would establish a more coordinated banking framework. Although not directly caused by this case, the broader era of instability accelerated reform momentum. The Phantom Bank became a cautionary reference. It demonstrated that documentation can simulate legitimacy. It revealed that absence of oversight invites fabrication. Financial systems depend on confidence. Confidence depends on verification. When verification is weak, perception dominates. Perception can sustain illusion temporarily. It cannot sustain liquidity indefinitely. The collapse altered depositor behavior. Investors began demanding proof rather than presentation. Paper alone was no longer sufficient. The market adjusted its trust threshold. Reputation became conditional. Structural takeaway: trust, once broken, restructures markets. The Phantom Bank belonged to the early 20th century. Its mechanics, however, are not confined to that era. Modern financial systems are faster, but psychology is unchanged. Today, institutions can exist entirely in digital form. Online platforms operate without physical branches. Branding substitutes for infrastructure. Interface substitutes for vault. Reputation substitutes for verification. Digital dashboards display balances in real time. Few users question underlying reserve composition. Financial technology companies often operate outside traditional charters. Regulatory frameworks struggle to classify innovation. Jurisdictional gaps still exist. Licensing definitions evolve slower than product development. Public adoption frequently accelerates regulatory clarity. This sequence mirrors the past. Social proof accelerates digital trust. User growth charts function like early newspaper repetition. Download numbers replace printed advertisements. Influencer endorsements replace editor mentions. Confidence spreads through networks instantly. Verification remains secondary. Statements are now digital rather than printed. Formatting remains persuasive. Clean interfaces imply compliance. Compliance is often assumed, not examined. Liquidity risk persists in modern structures. If redemption demand accelerates, fragility becomes visible. Recent financial failures have demonstrated this dynamic. When platforms halt withdrawals, confidence collapses immediately. Runs now occur in hours rather than weeks. Digital velocity compresses collapse timelines. Yet the foundation remains identical. Trust without verification. Growth without audited reserves. Perception without infrastructure. The Phantom Bank was primitive in tools, not in structure. Its core mechanism was outsourced verification. Depositors trusted because others trusted. Modern users behave similarly. Technology does not eliminate deception. It increases scale. It increases speed. It increases reach. The systemic lesson is structural rather than historical. Financial systems fail when verification is delegated to reputation. Reputation can be engineered. Verification must be independent. Structural takeaway: financial systems fail when verification is outsourced to reputation.